What's up, YouTube family? Welcome back to Market Grinders with Lydell and Amp. Once again, good to see you guys back. Don't forget to like, subscribe, hit that notification bell. Also, guys, please leave us a comment. If you guys got anything that can help us out building our channel, we're here for any questions that you may have. And if we do get those questions, we'll probably answer them on the following week. So thanks for tuning in. Alright guys, so today we're going to be talking about call options, okay? I know you don't heard that term quite a bit. It's another form of how you guys can invest in the market, and it's definitely a great tool in a way to building some wealth. So today we're going to talk about that today. Once again, you guys have any questions after this video, just shoot them to us. If we miss anything, just let us know, okay? So today we're going to start talking about what is a call option. So what is a call option?
Alright, so a call option is a investment strategy for leveraging your money while investing in stocks. And what I mean by that when I say leveraging your money, so for instance, if a one share, and we'll use AMC as an example, one share of AMC currently is $25 per share. If you wanted to buy 100 share of AMC, you would need $2,500. But maybe you don't have $2,500. So you can buy a call option for AMC. So a call option is a contract that allows you the ability to purchase AMC at a specific price, or you can sell that contract to someone else. So for instance, and I know we have some questions in regards to the mechanics of a call option. So I'll let you ask me some of the mechanics of the call option, so we'll make sure that we hit all our points.
Got it. So first of all, before we even start, so what is the difference between having a call option and just purchasing stocks in general? So there's a difference between the two. So what's the difference between the two?
So the biggest difference when it comes to purchasing a stock, for one, you can buy one share, you can buy a fraction of a share, or you can buy a million share of a stock, and you own it until you decide to sell it, or until that company goes out of business and no longer has stock available. So that's owning the stock. Owning a call option, you own the right to purchase. You own a contract with the right to purchase 100 share of a specific stock. So for instance, if you own a call option for AMC, you own a contract that allows you the right to buy AMC at a specific price during a specific time period. Now, if you own the stock, like I said, you can own that forever. If you own the call option, you only own that for a specific time that's written out in that contract. So if you choose not to purchase the stock during that time, or not to sell this contract to someone else, that option could expire worthless, and the total amount of money that you put in, you could lose that amount.
Okay. So basically you're saying, looking at AMC, if everyone looking at AMC is at $25. So you're saying that I would be able to buy it for a price less than the $25 in order for it to buy 100 shares, correct?
Yes, and I'll actually get into AMC. So if we're using Robinhood. So right now we're showing AMC's stock price. It shows AMC 25.64. So you'll click on the trade button, and then you get the option to buy AMC stock or trade AMC options. You want to click on trade AMC options. So then you get what we would call the option chain. And if you look across the top of the screen, you see the word discover, then June 4th, June 11th, June 18th, all the way out to, if you scroll all the way out to January 20th, 2023. So those are your expirations. Okay. So say for instance, if we wanted to purchase this options contract for June 4th, I will click on June 4th. And then it populates my options chain. So I will want to make sure that buy is highlighted, and I want to make sure that call is highlighted. And they are, you see buy in gray, you see buy in gray, and you see call in gray.
Yep.
Now you come down the chain, and you can pick buy the $28 call, buy the $27 call, buy the $26 call. And as you see, the $28 call cost me $3.85. The $27 call cost me $4.13. The $26 call cost me $4.48. So the price gets higher, the closer we go down in price. And the reason that is happening because you have something that they call in the money,
Yep.
at the money, and below the money.
Yeah.
So if you look at the current share price, $25.64. So $26 is very close to $25.64. So that means I'm saying that my call option will start making money after I hit the $26 mark. So I'm already at $26.64. So I have to purchase this for $4.84. Now the thing about buying a call option.
So before that, so the $26 at the call, is that what you call a strike price? Is that the strike price?
$26 is the call strike price.
That's the call strike price. Okay, we just want to make sure our viewers know that the highlighted bowl 26 call, that's your strike price.
Correct.
All right, and then on the right is what it will actually cost to purchase that per share.
And that's called a premium.
A premium price. Okay, so we want to make sure we're clear on that. So,
And one thing I hadn't covered, when you're purchasing a options contract, one contract gives you control of 100 share of stock. So as you look at the premiums of $4.48, that's actually going to be $448 because you got to buy 100 share. So you're buying 100 share at $4.48, which equates to $448. So now that's called my premium. So now when you think about your break-even price, right?
Mm-hmm.
So I have to. It's just like if you buy anything. If I bought an apple for 25 cents and I wanted to sell it for $1, my profit is going to be 75 cents. But I got to get my 25 cent back. I couldn't buy this apple for 25 cents and sell it for 25 cents. I don't make any money. I just break even. Yep. So the same concept when it comes to buying a options contract. If I purchase it for $4.48,
mm-hmm.
as this stock price starts to move up, I have to make my $4.48 back before I make any money.
Yeah. So
that means that this $26 will have to go up to about $30 before I start making money. But as I get to $30, and it's a range. It's not a finite number like if you were purchasing a actual object from somebody. But there's a range, so there's a bunch of things that happen, a bunch of math that happens in the background that gets me closer and closer to the profit without making a total $4 move. But I'm going to have to make about $2 to $4 move before I start making profit on this particular trade. So the thing about this compared to buying a particular stock is if I bought one call option for $26 and it moves up to $30, I got $4. I got $448 tied up. We'll make math easy. Call it $500
mm-hmm.
tied up into this trade. If I get a $4 move in one day, that may be a 50% price increase on that option contract. So now this option contract could now be going for $10 a contract, and I paid $5 for it. So I could turn around and just sell that contract to somebody and double my money. Somebody else is going to pay me $10 to own the right to purchase these shares, and I'll double my money right there. Or I can hold it longer and hope that it continues to go up higher, and then I can sell it for $12 or $15 or $20. It's easy to make a high profit gains on an option contract. So if I owned the actual stock, for one, if I owned 100 shares, I would have to pay $2,600. Not a lot of money, but sometimes it is a lot of money.
Yeah.
So I'd have to pay $2,600. So now I pay $2,600. I get a $4 move. I'm only up about 4 to 5%. So I pretty much only made $400 profit, off of my $2,600. That same move in the options contract, I made $500, but I only put in $500. You know what I mean? So I made 100% gain compared to a 5% gain. And when you the more money you put in, the bigger your gains are going to be from a percentage standpoint. Does that answer that question?
That's good. That answers the question. So just to make sure everyone is clear, so the $26 is the strike.
Correct.
So $30 is the break even. So
correct. And it calls it out, 36,
that
48.
Calls it out. So once it starts to move towards the $30 mark, that's when the profits will start to come the closer you get to the 30, 48. So, so that's good. So, what are some of the other things that helps determine when you buying an option, like far as the Greeks? And let's explain the Greeks first, and then we can explain how important the Greeks are compared to when you guys are purchasing the option.
So, looking at the options chain, I'll click on the $26 call,
Yep.
and then it brings up the screen for me to purchase my call.
Okay.
So, I could, if I type in one, it gives me the price of one call option, and that's $4.50 for the 26. And my expiration, if you look at the top, it says buy AMC, $26 call, 664. So I will own this one till 6 month, 4th day in that month, and it's gonna cost me $4.50 per contract, which it's gonna cost me $4.50 per share for one contract. One contract is gonna be $450. So I could hit review and submit, and I could purchase, right? But when we talk about our break-even price, we talk about our profits, there's a mathematical formula in the background that runs that kind of breaks things down for you. So what you want to do now, where it says limit price, click on that area, and now it brings up stats. You want to come down to where it says Greeks. So underneath the Greeks, the first thing you see, it says delta. Delta is 0.58. So another difference in buying a share of stock and buying a option or buying a call option is if you buy a share of stock and the stock moves up $1, you make $1. If you buy a option contract, your profit is still tied to the movement of that stock. So if the stock moves up $1, the price of your contract, the price of this particular contract is only going to move up 58 cents. That's what the 0.58 represents. 58 cent move. So for every dollar that the stock moves up, you make 50 cents on your option contract. So for instance, if my stock goes from $26 to $27, my option contract cost me $4.50. Now this option contract is worth $5 because I made, just taking the math down to 50 cents, I made 50 cents on that option contract. So now I can turn around and sell this call option contract to somebody else for $5 because I got a 50 cent gain, and that's 50 cents times 100 would be my profit on that particular trade if I wanted to sell it right then and there. Now, all of these numbers fluctuate. So another number that we want to look at, you see underneath delta, you have theta. So theta is time decay. So each options contract, you have a expiration date. The closer you get to your expiration, the more money you lose from option contract. So just kind of breaking that down for you, what's going on there is kind of like if you go to the grocery store and you buy a gallon of milk, and a gallon of milk expires in 6 months. This gallon of milk is going to be $2.50, and you can hold it for 6 months. If you go back to the grocery store and this gallon of milk expires in 2 days, nobody's going to give you $2 for it when they can go buy a gallon of milk that they have 6 months left on it. This gallon expires sooner, so it's going to be cheaper. So it's just the same thing happens with your option contracts. The closer they get to expiration, the cheaper they become. So what happens as my theta increases, that negative 0.63 increases, my delta decreases. So my delta may go from 0.58 down to 0.23 to 0.25. All that's going to change. So it's going to give me less money as the stock continues to run up. So those are things you got to be cautious of and aware of when you're purchasing your call options, knowing what your delta is and knowing what your theta is. And honestly, as a novice or first time investor, the biggest thing you want to worry about is your delta. Everything else is going to work itself out. So you see delta, theta, rho, gamma, and vega. All of those things deal with volatility. volatility, like your rho, your gamma, and your vega. They deal with volatility. So if you get a sudden spike in the stock, those numbers may change and go down. And all of these numbers combined, and you can do the math. If you add up all of these numbers, it has to equal 1 or 100. So what happens is, as I lose time, this number increases. So as this number being theta, as theta increases, my delta is going to decrease, my rho is going to decrease, my gamma and my vega is going to decrease, all to maintain that 100. So if I get a volatility spike, my gamma may spike from 0.0348 to 0.5349 or something. But as that spike, my delta is going to pull down, because these numbers are always going to balance themselves out to equal 100 all the time. And that's the math behind the scenes of your option contract. Another thing that you want to be aware of is volume. So this particular volume shows around 13,000. So an open interest volume is the number of people that have shares available, right, to sell or buy, right. You look at open interest, those are people that are already in the trade. Those are people who already either have, we're not talking puts, but those are people who either have the contracts for the calls or contracts for the puts. You want to always look for higher volume trades, because lower volume trades, the thing about the stock market, when you talk about options or you're talking about buying or selling shares, you are entering into a agreement with somebody to either purchase something or sell something, right? We don't meet these people, we don't talk to them, but there is a exchange. So if the volume is low and the open interest is low and there's only 2 or 3 people in there, you can actually get into an options trade and not be able to get out of it, because there's nobody there to buy it when you get ready to resell it. So right now, looking at AMC, and you guys know AMC is super hot right now with everything that's going on in the media. So yeah, so a lot of people are in. So it's very easy to get into an AMC trade and get out of an AMC trade when it comes to options contract. So and another thing to think about when you're getting ready to sell your options contract, when you hit sell, just because you hit sell doesn't mean it's gonna sell. Somebody has to be there to buy it. So with volume like this and open interest like this, you're fine. You can get in and get out, like, probably at a drop of a dime. But say for instance, if your volume was around 100, open interest is around 23, that means you gotta wait for one of those 23 people to say, yeah, I wanna purchase this contract from you. And they may not choose to purchase it until 6 minutes or an hour after you hit the trade button. But the market doesn't pause. The stock price still goes up, it still goes down. So if it's going down further than it was when you hit your sell button, you're gonna lose money, and you're gonna hit sell, and somebody's gonna buy that contract a lot lower than you chose to sell it for. And if you don't know those things, you look at your account, you say, man, I was up $500 when I sold it. Why did I only get $300 added to my account? Because really the trade didn't close until it was down to $300. So those are just some of the things that you got to be aware of when you're trading your options. Does that explain that?
Yeah, that explained that pretty well. So that's a lot of the information with the call options. That's a lot of information that I think is valuable for our viewers. And that's pretty much it. I mean, you broke down everything in detail. That's it. So unless you got something else to say, I think that's a good breakdown on how to do a call option. What you would say?
So I know I was a little choppy in the actually how to purchase a call option. So I just want to walk everybody quickly through how to purchase a call option. We kind of went into it in the beginning of the video, but we didn't go deep enough as we started to explain certain things. So now that you guys have a brief understanding of it, I just want to walk you kind of through the keystrokes. So the first thing and this is Robinhood, you go to your Robinhood app, you search the stock that you want to purchase. Now, they don't sell call options on everything. There's certain stocks that you can't find call options on. So don't think you're doing something wrong if you're searching for options and they're not there. And your account has to be set up to trade options. Options are, by a lot of brokerage houses, considered riskier investments, and they are, because you can lose everything in the option. So make sure your account is set up to trade options. If it's not, you can go behind the scenes on Robinhood, and you can set up your account to trade options.
Before we close out, I got another question, but go ahead.
All right, so right now we're looking at AMC. So AMC is at 25.64. You can actually see the chart of AMC. I will hit my trade button. I would then hit my trade option button. Then I will select my expiration date, and just for the sake of this tutorial, we're going to choose June 11th. I choose June 11th. I have buy, highlight, and then I have call, highlight on the other side. So now I want to choose my strike price. I'm the type of person I always try to purchase in the money. So what that means is I buy the contracts underneath the price of the stock. For instance, this stock price is now at $25.64. I'm going to buy the $25 call, which is already in the money, meaning that I'm already at a break-even price. So that, go ahead.
And then you can just make sure they're clear that the break-even price as you buy out of the money is cheaper.
Yeah. Your premium becomes cheaper the further out of the money you go.
Further out, so because in the money you're pretty much in the process of making money if it go up anymore. But out of the money, you got a time frame that you got to wait for the money to get there in order for you guys to make money. So out of the money gonna be cheaper, more above the line that you guys go. But go ahead.
Yeah, and just to break that down a little further, if you look at a out of the money call at $28, so for one, it's only $6 per share, but I have to go from 25 to 28, which is $3. And then I paid $6 for it, so that's about $3 more. So I'm at about $6 anyway, right? Now look at in the money, I'm already at my strike price of 25, but now I got to make up this $6.88. So to me, I would pay that 88 cent, just to get into profit quicker.
Yeah.
So now what I'll do, I would click on the actual call for 25. It brings up the purchase screen. I will enter the number I want to buy. Say if I want to buy one share, that's going to cost me $690, which is $6.90 per
100 shares.
For 690 cents per stock for 100 share. So now I want to click on my limit price so I can take a look at my open interest and my volume. So my volume is 6,000. Open interest is 4,100. I'm good to go there. Then I look at my Greeks. Honestly, me personally, I like for my delta to be around 0.74, 0.75. But with a volatile stock like AMC, I'm fine with the 0.64. And again, 0.64. The way I look at that, that's 64 cents. For every dollar that the stock moves, I'm going to make 64 cents. Yeah. And those numbers will change based on if the stock spikes. Those numbers change based on my expiration. Things like that. The closer I get to expiration, that number's going to go down as well. So once I'm fine with those numbers, I click back on the screen. I click review. And then I'm not going to purchase it, but you would just swipe up. You swipe up, and then it'll queue this order to be purchased. And you can do this when the markets are closed. You can do it when the market's open. It's going to take any money that you have in your buying power. It's going to take that money and go ahead and allocate it toward that purchase. You're not guaranteed to be filled. And what I mean by filled, you send in a purchase order, but somebody has to, you send in an order to purchase, meaning somebody has to sell those shares to you or sell that contract to you on the other end. So a lot of times if the volume's low, you won't get filled. So it'll ask you, do you want to fill 100% of your shares today by the end of the day, or you can set a time period on it. So what that means is if by the end of the day you don't get your order filled, it'll cancel it. Or you can say, no, I want to leave this open for a week. But just know that if you do this after hours on a weekend when the market's closed, like if you do this call option on a Monday, Monday's a holiday, so the markets will be closed, but it will allocate your money to purchase this once the market's open and people are ready to sell that contract. So once markets open, people sell the contract, boom, your order's executed, and then this order will show up in your trades. And then from there, you just watch it, and once you hit the profit margin that you want, then you just do the same steps. You just go, you click on your option, and it'll ask you, do you want to buy or sell? Because you can add more if you wanted to, or you can sell. You hit sell, you sell the contract out. If you're up, that money goes into your trading account. If you're down, whatever money's left from the trade goes back to your trading account. And what was the last question you had?
All right, so just want to let them know, I did hear you say that, but make sure they're always aware of your break-even price, no matter what you guys are buying in or out of the money. That's going to be important as well. So it possibly happen, just say for instance, that you have a call option and then it expired on Friday, and it expired, but you guys, you expire out of the money, so you don't have any money in it. It's going to come up with a saying where it says that it'll give you the option to buy 100 shares of that particular stock in order for you guys to what? I mean, what is it saying when it's saying that?
So that's a big thing to know. So what Lydell's explaining. So when you enter into a option contract, you have the option to purchase 100 share of an underlying stock at a particular price.
Okay.
So there's two ways to make money or lose money in an options trade. One is to make money, you sell your option contract to someone else at a higher price.
Okay.
I paid $4.50 per share. I mean $4.50 per share for one contract, which is $450. The stock price goes up. Now my contracts are worth $500, right?
Okay, yeah.
So now I turn around and sell something that I paid $450 for to you for $500. So I made my 50 cents per share. I move on my business. Now you have this contract and it's getting near expiration.
Okay.
But the stock price is not where you need it to be. It didn't go up high enough. So if you sell the contract right now, you'll lose money because now you pay $5 for this contract, which is $500. But the stock price has dropped from 26 to 25.50. So your contract price has dropped down from $5 back to $4.50 or below. You know, but you're not making money. You're in the negative. You're losing money.
Yeah.
So now what you can do is you can exercise your right to purchase those shares. So if the stock price, whatever that strike price is, the strike price is $26. You can exercise your right to purchase the 26 shares of the stock now from the person that you bought this contract from. So now what you do is you don't really, you have to come up with some more money to purchase these shares, but you didn't lose on the contract. Now 100 shares actually go into your account, and you can sit there and hold that as long as you want to now until the stock price gets to a point to where it's profitable again. Or you can hold that and turn around. You can sell you can create an option contract and sell 100 shares to somebody else if you wanted to now. But so you what basically, long story short, you exercise the right to purchase those shares. And just to break that down a little further,
that makes sense.
That's what's happening with the short squeeze when you think about what went on with GameStop and what's going on with AMC.
Yeah.
So they they do puts. I mean, we'll explain puts a later time, but just a quick overview of puts. Puts is you buy an option contract and you think that a stock price is going to go down. And the further that price goes down, the more money you make.
We're gonna have to break that down on the video so they can see the difference between when you get the price, because it's kind of backwards.
Yeah, puts are
kind of backwards. So we definitely want to explain that on the tutorial.
Puts are a different ball game. But I just want to explain the exercising portion of buying the shares, right? Yeah. So if you thought that the stock was going to go down, but the stock starts to rise, and you bought $1 million in a particular company, and the option contract is going in the wrong direction. So now these contracts that you bought are becoming worthless. You're not going to lose $1 million when you have the money to purchase the shares of that stock. So you're going to say, all right, I'm going to just buy the shares. Yeah. So you buy the shares. So once you purchase shares, the market says, wow, people are buying. People just bought, 5 million shares of AMC. So as that money goes into the market and these shares come off the market, the price of the stock goes up. So that's what causes the short squeeze. These people don't want to own this share. They want the stock to continue to drop.
Yeah.
But they also don't want to lose a couple $1 million waiting on the stock to drop. They'll rather go ahead and buy it and hold it and let the stock run up and then sell it at a later date for a profit.
All right, but that's good information. So I think that's pretty much it. Unless you got anything else, but I think that's a good part of it. All right, guys, thanks for tuning in. Don't forget to like, subscribe, hit that notification bell. Send us a message if you guys want us to hit something that you guys are unfamiliar with. You guys want to know about it, and we'll be happy to on the following video. All right. So thank you guys for tuning in. Keep grinding.
Peace.
Peace.